So we have our afternoon plenary address entitled Trading China Under the PBoC's Watchful Eye. The address will be given by Mr. John Taylor, President of Taylor Global Vision. Mr. Taylor began his career at Chemical Bank in 1969, entering FX markets in 1971 when the dollar began to float. He became the head of Citibank's North American Marketing Advisory Services and Research for Foreign Exchange, and in 1981 founded FX Concepts, a multifaceted investment management company which managed $14 billion in assets by 2008. He also served on the New York Federal Reserve's Foreign Exchange Committee after the 2008 recession and is known for his strong views on governance, market structure, and global liquidity, all very current topics. His recent company, Taylor Global Vision, is focused on short and long-term macro research with an emphasis on short-term market cycles and long-term macro dislocations and profit opportunities. John, please take it away.
Thank you, Ava. Thank you. I'm here to talk about China, 1/4 of all the people in the world, and the fastest growing and most fascinating place out there. But China is not like everywhere else. We think the first thing to understand about the Chinese market is that it's not all there. From a trading point of view, it is effectively blocked out. And let me explain what I mean. We find it very useful to think of the foreign exchange market as divided into 3 subsections. First is high-frequency trading. The second is the kind of stuff that everybody did in the past and still does today. They analyze the market, look for the next 1 to 2 weeks, and try to get it right. And the third is to look for valuation differences and really long-term political strategic moves. Those things are separated in time, but they're also separated even more so in the point of the freedom of the market. The Chinese market is not free. And for that reason, when you go into China, you're not going in on an even playing field. The country is run totally from top down. Confucius, communism, and technology are all top-down processes. And I think it's very important to remember what the thought process is actually in at least Confucianism and communism, that the currency is there to help the country. Foreigners are there to invest and help the Chinese people. Speculative profits don't help China. And authorities know the way, what is right. And I could have said exactly the same thing 600 years ago, and I would have been talking about China. Nothing has changed, right? What I know about China, I've been there for several months one summer, and been there a bunch of times other than that. But I know 2 old party members well. And they're elite families from a communist point of view, i.e. their dads were on the Long March, fought against the Japanese, were there at the beginning, set the country up from the scratch, were friends with Mao. The 2 children were at the highest of high state schools. Not only were they elite, but they were blanking smart, right? Now they're part of the Chinese diaspora, but they still believe in Confucius. They still believe in communism. It might be their communism. And they also believe ferociously in technology. That's what these people are. By the way, they met in some rural boondock where they were both exiled to by the Red Guards, which shows that they really have that Chinese background to them. But they're the perfect example of why the Chinese system works and why the Chinese system is what it is. They are extremely smart, extremely committed to the country, and resourceful, and positive thinkers as well. They're tough competition on any field. They were both senior engineers that were originally sent out of the country in order to allow, in one case an American, in one case a German company, to become more intelligent so that they could invest in China, so that would help China grow, so China could get the information. Now they live in the West. I think what's really important is to know that they represent the Chinese characteristics, and when you look at how to trade China, you've got to think of what China starts with. All of these top-down issues, right? High-frequency trading is one of our three ways to trade. And at least from my experience, it's the most successful way to trade. It's very good, but it's extremely capital intensive. It depends on continual and intense understanding, blah, blah, blah. You can go on and on and on. But underneath it all, it also depends on the system structure. And it depends on them not changing the system structure. So none of this is any good if the system is rigidly controlled and can be changed without you knowing anything about it. High-frequency trading can win at some points and be quite successful in China, but it can always be squashed by the authorities if they see the need to squash it. And trading this way is a poor risk return. I kind of compare this to the situation where you're a robber and you're looking at a bunch of houses or whatever, and this one has an ADT protection, and this one has one other company's protection, this one has none. You rob the one that has none, right? You ignore the one where you're likely to get caught. So in high-frequency trading, don't trade the renminbi. That's my opinion. The next kind of trading, I think I should say one more thing about the high-frequency trading. It's a little bit like the Swiss market in the 1960s. One of my bosses in the very old days was a fellow who ran Citibank Zurich's office, and he was, before that, head of one of the Swiss trading banks in the 60s. And they set that Swiss franc market every day, the three big banks. They played with it, and they handled it. They made a lot of money off of it, and the rest of us poor boobs outside of the country, we lost money all the time. So Citibank never was successful. That's why we hired this guy from a Swiss bank, so that we didn't have to put up with that. Of course, then the dollar started to float, didn't matter anymore. But trading the renminbi is like trading the Swiss market in the 1960s. The second type of trading, this currency analysis, is the kind that most of us work with. But my experience with China is that the authorities pride themselves on wrong-footing the market. It's the only country that I've ever gone to and talked with the SAFE or a central bank and had them ask me if I actually traded in that currency, like I was some kind of a criminal. It was like a grade B movie. They don't like short-term trades to be successful. They like to make sure that they keep the market off balance. I think a good example is the Hong Kong issue that came up last fall when the streets of Hong Kong were utterly blocked and crowded, and the country was having all kinds of problems and volatility jumped up. The currency didn't move an inch. It was locked in there, right? Because we Westerners could see that, oh man, Hong Kong was falling apart. There was a possibility of something going on. Let's do something. Forget it. They weren't going to have that. The currency is theirs. It's not ours. It's theirs, right? It's their renminbi, not mine. And according to the guys that I visited from the bank and also from the big insurance companies or whatever, they all were upset with me because I had a reputation of a trader, and maybe I was trading in their currency and I was really not allowed to play in it. Which brings us to a way to trade China. Carry trading. Political trading, I call it. They're the trade the authorities want you to make. For us, long-term trades are the only ways to trade this market. But you're either with the authorities or you're against the authorities, right? The carry trade is absolutely 100% with them. That's not to say that there aren't bumps along the road, but the bumps aren't our bumps. Those are the bumps that come from Beijing and Shanghai when the authorities decide that, in fact, they want to have a bump. Right? Now, that maybe doesn't hold in every case, and we'll look at a slide later that shows that maybe they aren't totally in control. But mostly the changes are made behind very closed doors in Beijing and Shanghai. You either follow the strategy Beijing wants, or trade somewhere else. Knowing when Beijing is going to make a change is like watching the Kremlin. And I'm an old guy. I remember watching the Kremlin, wondering, God, I wonder what they're going to do inside of that wall. What's happening? You don't really know what's happening in China. You can't really effectively play that game. Are you Chinese? Do you speak Mandarin? Do you have access to the party? All of those are really important questions to know what's happening in that market in China. And so trade with the authorities. It's the easy way to go. The carry trade is the biggest trade in the world by a factor of X. I don't know what that factor is, but it's certainly higher than 3 or 4. And that's the way they want it to be. It works, but it's like buying something that's in a bag. You don't really know exactly what you've got. By going long CNH or CNY, you're doing actually what they want. The profits might be small, but they're just enough to get you to do it. And they make it good by making sure there's no volatility in the currency. So your model will tell you trade, whoopsie daisy, I did not turn this thing off. That's my wife checking up on me, right? I'll tell her I'm here. Right. The profits are small, but they're just enough to get you to do it, and you look at it and you say, my God, there's no volatility here. But this is a top-down controlled situation. When the government is totally in control and when everybody is happy, the volatility is low and the trade is successful, and it's a wonderful thing to be in. I have to remind you of the Euro-Swiss. It was wonderful between, summer of 2012 to December 1st or so of last year. And then it got more and more dicey or whatever, and you could tell it was going to blow up. And in the charts that I put around here is a copy of a letter I wrote on December 15th saying Swiss franc was going to blow up. It works until it doesn't work, right? Basically, we call these trades picking up nickels in front of a freight train. When the authorities either change their mind or lose control of the situation, which really is what happened in the Swiss case, as an investor, you're just totally out of luck. You're like McDonald's in China. Remember McDonald's? If you were followers of China, whatever, they had the largest selling McDonald's store in the entire world was in Beijing, very close to Mao's tomb and all that stuff, right? The largest selling store, very, very large. They had a 99-year lease. It had like 80 years to go, or maybe 85. The Chinese said, you're out of here. We want that space to put up a parking lot. And we don't care whether it's your largest place. We don't care whether you have a lease. You're gone. You do it my way or the highway. And so that's what happened. McDonald's lost. And who cares? This is what my two friends told me. McDonald's loses. Who cares? We're Chinese. They either trade with us or they don't trade with us. So you have to remember that that's the thought that the authorities have. And it's no different, actually, than the thought that any major company has in controlling their assets and what happens to them. They control them, not you. So if you're looking at like a General Motors or an IBM, before General Motors, before 2008, and IBM before people discovered that they didn't have to have mainframes, which is now, 25 years ago. So Chinese are controlled, punto final. The only way to trade China that we look at as successful is what we call the George Soros style. Finding the places where this thing is going to break down. Remembering that what I said is that these guys are controlling the situation. In the long run, something will happen. But of course, the long run can be very long. This is the way we trade. And sometimes you must accept that there aren't any trades at times, right? You just have to say, okay, well, there's really no way I can trade China unless I want to do the carry trade, and then I should look and see what's going on. But if we want to talk, I can tell you about 6 reasons why the carry trade is in big trouble. And actually, we'll talk about that here a little bit. The mistakes come seldom, but it's in all top-down systems, and there General Motors and IBM fit the example very well. When mistakes come, they come big. They're not little mistakes. The system breaks down, right? Or they have to make drastic changes to the system. Same thing. Well, we're in luck because the Chinese system is creaking. The authorities are being pressed by so many competitive problems, they might change their strategy. And some external analysts would argue that. And I'm not just saying, the ones who are against China all the time. I heard someone in another speech earlier today arguing that point. They're very good. They're very organized. They're very smart. They're on top of their game. However, they might be forced to change because the situation is changing. China is caught between two opposing needs. The first is they need to attract more capital. This is my chart from about a week and a half ago. They need to attract more capital because most of their companies, the SOEs, are losing money. And you have to think of an SOE, just think of the Pentagon. The Pentagon is an SOE. It's a state-owned enterprise, right? Does it lose money? Yeah. Is it ever going to pay back the money that the federal government gives it? No, you got to be kidding. That's the way the Chinese see the SOEs. Now, they've straightened them out. This is communist theory. This is how these countries work. They've straightened them out and made them look nice so that you can buy stock in them and you can buy bonds issued by them. But in fact, behind all of that, there is, in fact, a flow of money coming from the central government. So, in fact, China needs capital all of the time because it's not a capitalist state. It doesn't really generate capital the way the capitalist states do. I mean, they have a stock market, but that's small potatoes, right? So they need money. So that's why the carry trade. That's why they're borrowing $1 trillion in the offshore bond market. That's why they want to be in the SDR. That's why they want to have the AIIB. Those things all they see as bringing money to the country. I see that too, and I think it's a very good strategy. There's nothing wrong with the strategy, but it might not work. The other point is that other problem why they're between a rock and a hard place is that they're a communist country, which implies something else. They're there for the worker, and they want the worker to not be slaving like the guys in Greece will be, but they want the worker to, in fact, enjoy a decent growth and life standards and all that sort of stuff. And some Westerners who don't like the Chinese say, oh, well, the workers are going to have a revolution all the time. Well, that's not right. But the Chinese authorities believe, as does the whole country, that you should make sure that the workers do better and better over time. So China needs to get more capital, and it needs to grow fast, right? So the reason this is important is that they don't fit together. If you keep the Chinese renminbi steady, like they've done here, keep the interest rates inside of China higher than they are in Hong Kong so that the capital flows in through the carry trade, and you're losing export share, and you're finding out that the Bangladeshis of the world are taking part of the market away, you end up with two different guys sitting in that room in Beijing, which I can't see. And I just know they're there. One is the manufacturing representatives who said, Jesus, we need to have a lower renminbi. We've got to get this currency down because we're not getting the exports we want and blah, blah, blah. And the other guys are saying, no, we need the capital. We need to keep the rates up. So there's a little battle going on in there, we're guessing. And right now that battle is a total standoff. And this chart up here shows that total standoff. It's interesting, this chart has a couple of interesting points. In the first quarter of the year, which is what's basically on the left-hand part of the chart, the renminbi weakens, the yuan weakens, and the dollar strengthens. That's because the U.S. was going to raise interest rates. And everybody thought the U.S. was going to raise rates and China was under pressure. But they weren't under that much pressure at that time. Things were really looking okay. They weren't really too worried. The stock market was going up. They didn't need to worry at all about what the renminbi was trading at. So the carry traders lost some money. That's one of those cases where we really don't care. When right at the top that it begins to turn around and go down, geez, Janet Yellen was speaking. And the U.S. basically put off. The numbers in the first quarter looked terrible. We put off the raising of interest rates, and boom, the renminbi came down. So the Chinese might control everything, but they don't, right? I mean, the U.S. interest rates do control something too. So nowadays, I've got a little question mark and things breaking out to the upside. What is that for? That's because maybe we are going to raise rates again. Madam Yellen speaks again tomorrow. We'll see what happens, right? And by the way, that chart is a couple of days old, and the government is not letting it go any higher. It's been sideways to flat ever since it broke through that line. So my point is that devaluation is becoming an option for China. If they can't attract enough money, then the best way for them to get capital is what they have done their whole life, which is have an incredibly strong current account balance. And there you get the capital in there. Another way to get capital is to make sure that everybody, in fact, deals with renminbi. Try to internationalize the currency so people will actually take money in renminbi. I had someone yesterday or the day before telling me, geez, we got this fantastic deal. They're going to give us $46 billion to do X and Y and Z or whatever. I said, are they really giving you dollars? Well, no, it's $46 billion worth of renminbi. Okay. That way they can make an international investment and protect themselves. Now, obviously, they can't do that with the American corporation that they just offered to buy overnight, but FDI is an interesting critter. Looking at this chart, I'd say that the authorities are praying for something to happen. And, and I'm not sure that what they're hoping for is in the cards, because I think U.S. interest rates are going to go up, and that's going to put China into a bigger problem. And if the economy keeps slowing down or whatever, I think China could devalue. And I don't think China will care that much if it devalues. What it's losing, if they lose the game with the SDR because of the stock market problem, they're going to find themselves in a different sort of situation. They're going to say, well, I can't be as international as I want to be, so I might as well pull back my horns and make sure that my economy and my workers are working. So I devalue. Chinese need to carry trade, especially now with the weak equity market. I would argue that the authorities will win unless they're forced to throw the carry traders under the bus. And if they do, they will. The question is, will capital keep coming? And that brings us to the stock market. This is a chart from my May 20th letter, where that red box, unfortunately for me, is in September, but it's exactly the level that the market went to. I mean, we had the level right. We didn't think it would go there that quickly. The equity market has been taking the heat off of the carry trade. It's very, very good for the reputation of the country. Makes everybody look at China and say, what a great place, or before 3 weeks ago. But it's small potatoes, but it does make people put money into China. And it also helps the non-SOE companies, the ones that were hurt by the crackdown by Xi on the shadow banking and all of this stuff. It allows them to float IPOs and to get money into them. So it supports the private sector. That's very good. And it's a great PR platform. And the authorities made a mistake. They let the economy grow, the equity market grow too quickly. I mean, you can't have a tree grow to heaven. I mean, we weren't totally wrong, I think, by saying, oh, geez, it's going to get there in September, October. The authorities were wrong. They let it go too fast, right? Chinese needs the equity market to play. China wants to play for the long haul, but this market got too high too fast. So we called the bottom at 41.75 a couple of weeks ago, and 2 days later it was at 3,500. We called the bottom again, and so far we're winning, but God knows. I do think the market will steady, but I think that China has lost a tremendous amount of reputation because of that. The Chinese can make a mess. I mean, certainly this equity market has been an example of making a mess. But on top of it all, the ending of the mess, where the Chinese have shown that they will go to ultimate extremes to stop the market from going down. Even if they have to outlaw selling stock, have to delist half of the market, and give tons of money to brokerage houses and create new lending abilities. They don't want to lose control. They are in control. But we have to think of that as investors ourselves as to how can we live with that control? How do we take advantage of it? Or how do we stay away from it, right? We have to recognize first what China's goals are. There's nothing wrong with those goals, but those are their goals. What they will do to reach them, which are very powerful, they're much more powerful than any other government in the West. But behind it all, these are just people running a top-down organization that will eventually blow up. Smart they are, brilliant they are, capable they are, but it still will eventually blow up. They always do. Now, how do we trade this, right? We have to be like George Soros. We have to say, my God, it's going to blow up. How do I handle that, right? And just for the last little bit, the best strategy I could see is the market's got a very low volatility, straddles, right? Far out as you can get, they're cheap, right? And if nothing happens in the next 6 months, if you do a 18-month or 2-year straddle, you can probably get your straddle back and lose maybe 20% of the original cost you put down in the first place, and then do it again. There are more sophisticated ways to do it, but it takes a hell of a lot longer to talk about it than that. But we have to remember who we're dealing with. Great country, great idea, tough, tough, tough place to trade. Thank you.